Chairman Jerome Powell just slashed the Fed funds rate by 0.5%, and investors are wondering what happens now. Based on his commentary, he's suggesting that this is the beginning of a cutting cycle, so we're going to see more interest rate cuts in the future. He talked about a commitment to not get behind in terms of the economy. You don't want to see a picture where there's a significant slowdown in the labor market and the Federal Reserve policy is not accommodating to it. And so broadly, these are the comments that investors want to hear, but the initial reaction was more muted despite today's rally because largely investors were saying, hey, we expected this, where you can see the betting markets were saying, yeah, by the end of this year, 2024, we're expecting not just 50 basis points. That's actually baked in. They're saying that if it's just 50 basis points, there's only a 2% chance of that happening. More likely, you're going to see a whole percent or 1.25% in terms of cuts just this year alone because of the softening of the economy. And maybe it's because looking at the labor market, seeing unemployment finally ticking up. Is this part of a bigger trend where you start seeing it, really start to spike higher? There are some sort of technological developments happening right now with robotics and AI. Maybe that leads to worsening labor conditions. I mean, currently unemployment's around 4.2%, which relative to many prior periods, you'd say, yeah, that's broadly low, but maybe this is the beginning of an unfortunate trend. You don't want to see this at 6-7%, for example. A more cynical take might be, hey, maybe this is due to politics and they want to, impact who might get elected, increasing the odds that the incumbent gets reelected or the incumbent party gets reelected. Another cynical take might be that because the U.S. federal debt is just exploding, that this is something that's required to happen. You need to lower the interest rates just to deal with the payments that are going to be due. Personally, I don't view those cynical takes with, I view it with some skepticism. I think Jerome Powell is indeed lowering rates because he's looking at market policies and he's looking at market action and the pricing of the bond market and saying, okay, I think the labor market is, weakening. I really do think that's the case. I don't think he's trying to put his hand on the scale with the upcoming U.S. presidential election. And so we're going to talk more in this video about, thought process for what investors can do now that Jerome Powell has cut the federal funds rate and is likely the beginning of a cutting cycle where it might be, based on betting markets this year alone, a full 1% reduction in the Fed funds rate. And if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. I appreciate you hitting that thumbs up, hit that subscribe button if you enjoy that educational investment content. And so what's next? First, previously, cash at Interactive Brokers was yielding 4.8%. They haven't updated their website since then. This is personally where I keep my funds. So I imagine that it's now probably closer to 4.2% and probably going to be heading lower as the Fed funds continues to get cut, in the months ahead. So once again, check out Interactive Brokers below, the link below in the description. I think broadly, you're going to be seeing a tug of war between animal spirits and how, badly the underlying economy is looking. So the animal spirits are saying, hey, with lower interest rates, it's now more compelling, let's say, to own either stocks that are yielding X percentage, or you might have growth companies where the substitute effect or the alternative effect of saying, hey, the opportunity cost of cash yielding closer to 5%, well, now it's 0.5% less. So now you go, okay, maybe I want to own more speculative things. So you have that sort of theory that, hey, maybe the animal spirits will win, but that assumes that the underlying economy doesn't worsen and that, the tug of war go to a much, faster decreasing economy. It is worth calling out that it actually to the day, September 18th, 2007. So fast forward several years or go back several years, you could see the Fed policy was the identical move. And in this case, the September 18th, 2007, 0.5% cut in Fed funds policy. And once again, this is a CNN article from 2007 talking about the only question was whether the Fed would lower the federal funds rate by 25 basis points or 50 basis points. Exactly the same thing that happened this past week. Very similar interest rate. So pulling it to 4.75%. And, talking about how it was a bold cut. And yet even those, it was a sizable cut, 0.5%. It still resulted in, because that tug of war lost out to the underlying economy contracting much faster than, was expected. You ultimately had a very sharp contraction, in equity prices as well, a 50% plus drop. When I look at alternatives for investors, this is the Treasury yield curve, and you can see by 1 month, 6 month, you can see the duration. Broadly, it's not that compelling. You can expect that this short-term rates will keep going lower with Fed funds going lower later this year. 2-year has dropped significantly, suggesting economic weakness. It's currently around 3.6%. And even the longer dated, not that compelling. A very flat yield curve around 3.5%, you could say, looking out at 2 years and beyond, where, 20, 30 years at 4%, it's just not crazy compelling. Now, could you have a period where this starts to spike higher, and could that, have ramifications for the equity markets? Absolutely. But so far, if investors are looking for a safe haven, I'd argue you're not really finding that much compelling value in treasuries. If you move to corporate bonds, once again, the spreads aren't there. And this is the relative spreads. This is measuring investment grade bonds relative to the underlying treasury index, the spread, the additional benefit that you're getting by owning corporates. And you can see going back for a long period, this is near the lowest it's been. You're only getting a 1% premium for the additional risk of owning corporates. So I'd say that's also not, let's say a safe harbor for investors. So, where do you go? Some investors are saying, hey, I'd rather go abroad. And so you've seen in the last few days, the US dollar dropping by about 3% versus the Brazilian real. So some investors saying, hey, I'd rather take my money and put it in Latin America. You also are seeing some investors move it to more speculative assets like Bitcoin, which is also up 5% in just the last few days. So these are some of the dynamics that's going on. I think you might also see a migration to cash flowing stocks with reasonable yields. Maybe that's one exercise that investors are consider. After all, they're going to say, wait a second, I'm getting less and less on my cash, or at least that's expected in the future. So let me find these companies that are stable and durable, and let me show the due diligence process with just one example. This isn't necessarily something that I'm buying right now, but this is the process that I think a lot of investors are going to be considering. First of all, as always, this is not financial advice. Quick plug, last week, James, a premium member of the exclusive Unrivaled Investing community, shared the following. This is a direct quote: "Was very happy to have re-upped my annual subscription, enjoying the contributions and wisdom of the Unrivaled community. If you're looking for compelling ideas, come check out Unrivaled Investing." By the way, rates are going to be going up for Unrivaled Investing, as I've tried to keep the services and the pricing low, but it's the premium tier, I believe, is significantly below market rate. So I do expect that to be going higher soon. So thinking about the exercise that investors are doing, there's going to be a lot of different iterations of this process, one of which is looking for companies, let's say, yielding 4%, a minimum of 4%. So saying, hey, I'm getting less on my cash, so maybe it's 4%, maybe you want to set 3%. Then I also want to set some sort of growth rate, I'm assuming around 7%. And then, by the way, I'm going to leverage AI here, this AI Ticker Chat stock scanner. And I'm going to say, hey, I want examples where management talked about recession-resistant business, because truthfully, I don't think anyone knows with certainty whether or not the bull or the bear ultimately wins or loses that tug of war game of, does economic conditions worsen faster than sort of the animal spirits start taking over? Do you have a sort of situation where the monetary policy doesn't, stay appropriately aligned to the underlying economic conditions? So let's play it safe by saying recession-resistant businesses. So this is what I think is the process that some investors are going to consider right now. Other investors might consider more speculative assets, might say, hey, I'm going to move into, let's say, the tech-heavy NASDAQ, and that's why partly it's up a couple percent today. So I think you have this dynamic where some are saying, hey, I want to find the things that I can, be comfortable with and retire and not have to worry about. Some people are saying, hey, lower interest rate environment, why not sort of push the risk curve or push where I want to go. So running that framework of 7% sales growth for the next few years, management calling out recession resistance, and a 4% dividend yield. One of the first companies that shows up on that list is Golub Capital, GBDC. I have no position in this, but I just want to share sort of the due diligence process as a company that fits an interesting screen. So this is an example. They talk about being a market leading direct lender. So they're providing loans to the middle market. You're talking about generally smaller companies, maybe a company under $100 million, let's say enterprise value, maybe under 200 million. So these are private companies generally that they are providing loans to, providing capital to, and they've been around for some time, since 1994, and they're managing tens of billions of dollars, a sizable team. Okay, and management's talking about, wow, they pay a pretty sizable dividend, 11% plus, and their debt to equity seems manageable. As long as the underlying equity doesn't start falling apart, seems manageable at around 1.05 times. So I'm looking at this thinking, okay, this is kind of interesting. My interest is further piqued, when I see that management has actively been buying shares for the last few months. I personally love to see insider alignment and insider buying, and there's been a lot of it. So I do like to see that. Understanding the business model, I think, is even more important than getting alignment. You need to get both ultimately. And you see that this is a business model that's primarily a spread business. And what I mean is they're investing in loans and they have debt that they also have to pay back. So can they get a favorable spread on the loans that they're investing in versus their debt? And you see they have around $8 billion in investments and around $4 billion in debt. And they're issuing shares over time, increasingly issuing stock. And that's sort of the business model of these business development companies. And you can see, based on their most recent originations, it's primarily this 8% senior secured, 90% one-stop. I'm not really familiar with the one-stop. It sounds like one-stop shopping, so we'll cover that in just a second. And you can see around 11% interest rate. So they're making new loans at around 11%. Mostly this one stop. I go to AI Ticker Chat. I ask, what does management mean by one stop? And it means effectively that one stop shopping. This does pose some risks though, because they're talking about, look, this makes it easier for the borrower because they don't have to coordinate with multiple different lenders. They don't have to juggle different, deal terms and lenders and requirements and covenants with these different loans. They just have it all one place for these companies, for a working capital facility, senior secured lending, all their money coming from one-stop shopping. And that's what it means. And by the way, chatting with AI Ticker Chat now is completely free to use. So if you have any questions about your US companies that we cover currently at AI Ticker Chat, come check it out. It's completely free to use. And so the challenge with this one-stop process is that it does create some, I'd argue there are checks and balances when you have multiple lenders under the same umbrella or under the same roof, because it prevents, let's say, bad money following good money, where you might have a situation where if a company starts turning south, you can paper over the problem if you're a one-stop shop, because you say, oh, we cover everything here. But if you have the checks and balances, when a problem starts happening, then you go, okay, pound sand, go get capital elsewhere, and then you're going to see much higher terms. And then, by the way, you're going to be required to mark down your loans, because if you're the senior lender and then all of a sudden the company has to raise, more capital, and maybe they're trying to squeeze you out of your top position as senior lender, you might have to have some sort of markdown on that. So this type of one-stop shop, yes, it is favorable arguably for the borrower, but it does have inherent risks to the investors, the outside investors, the shareholders, to say, hey, do you really trust the figures? And is it possible that they might make bad loans? That's the key question. You can see that it's a very diversified portfolio. About 26% is in software, but the rest is very small. 5% insurance, 5% automobiles, 5% IT. And it's mostly this one-stop shop first lien. So all the debt of the company, it seems like, is primarily with these businesses, with their borrowers. They're saying, hey, we're everything, all the capital we need, we're getting from Golub Capital. And you can see that, yes, they're getting around 11%, and their cost of borrowing is around 6.5%. And they have several different loan facilities outstanding, or several different bonds or notes issued that are going to be coming due in the coming years. And yeah, so 6.5% versus 11%. So it's a 4% spread business. Looking at their loan book, you can see this is just one tiny sliver of a, much larger $7-8 billion loan book. And you can see their amortized cost just for these auto components loans, this is around $47 million. You can see a lot of loans yielding around 11%. It's a bunch of companies that I frankly, and loans that I haven't heard of, businesses I haven't heard of. That makes sense. It's these small middle market companies, one-stop senior secured offerings, do in the coming decade. And, it really comes down to, once again, if management's saying, hey, their book value or their investment loans are $7 to $8 billion, can you trust the figures? Here's one from North Haven Falcon Buyer where they're getting 8% plus. And they're saying, hey, it cost us 8.3 million, but we're marketing it at 6.7. How do you trust that 6.7 is accurate? Because ultimately it comes down to management saying, yeah, these are the accurate figures. These are all the correct figures for what this loan book should be. It's not like there's a publicly traded market for this loan book. And this is also challenging because, you look at, if you're going to trust management, ideally they have a long-term track record of creating value. So one of the things I check is, hey, has Gulab generated, let's say, outperformance relative to the indices? And that's not what I'm seeing here if I zoom out from a multi-year perspective. And then I also look at, sort of the uncertainty of their internal markings, and I see that 10% of their loan book has borrowers that are out of compliance with their debt covenants. Now they're still getting cash. Loan payments are generally not past due, so they're still getting their payments in theory, but around 10% of their book can be marked down in theory. And so I just look at this, and this is an example of just something being too hard. But I think this is the process that investors are going to be considering right now, which is, hey, managing this sort of trade-off of, hey, I'm getting less interest on my cash. So, it's gone from 4.8% to maybe 4.2%, 4.3% ballpark. And, it's going to be a question of, do I want to swing for the fences with growth stocks that might be unprofitable? Do I want to, look at these dividend players? And I think, as always, it's case by case basis. You have to, size up the individual situation saying, hey, do I like this management team? Do I like the risks, the assumptions that I have to take? With something like Gulab, it's, yes, that's a high dividend rate, 11%, like management's calling out, but I don't think I could sleep well at night not really understanding this loan portfolio that they have and trusting the marks. Like it's sort of hard for me to say, if you haven't generated just crazy returns since your IPO, or you've significantly underperformed, and it's a bunch of private marks that I sort of have to trust you with, that's just too hard. And then you self-acknowledge that, 1/10 of your book might have issues. Just too hard for me. Might work out from here, but not part of my investment journey. I'd rather look for things that, yes, I think the recession resistant theme might be prudent. I personally prefer to have that sort of, belt and suspenders type of approach. But every investor is different. So if this video has been helpful for you, talking about, what sort of happens next now that the Federal Reserve has cut the Fed funds policy by 0.5% and doing some due diligence on one company that sort of fits these parameters of a, dividend yield and growth rate, let me know if this has been helpful for you in the comments below. Thanks so much for tuning into Unrivaled Investing.